as you know, Brian Jacobsen has a PhD, and that means that he is a professor. Maybe one of your freshman students might be able to serve on the Federal Reserve because of the fact that the Fed's rate is at 5.5% and market rates are about just over 4%. And they can't fight market rates, but they are trying like heck to do that. But really, if you watch market rates, it certainly suggests that the Fed rate is way too high.
Yeah, the Federal Reserve does have this tendency to follow the market lower. And so when we look at what's called the shape of the yield curve, and so what the Federal Reserve controls on the short end, right, that 5.5% federal funds rate, but then we look out as to, say, the 10-year Treasury, that yield is quite a bit lower. And the Fed is likely going to have to move in that general direction. That's what the market is telling the Fed. And I think you're right. I mean, my students, they're fantastic. They also have a boatload more common sense, I think, than a lot of the people on the Federal Reserve Board. It is likely that the Fed is going to have to follow those market rates lower, probably start in September. And that has some real consequences for investors, not just in terms of the yield that you might get on money market funds, what might happen to fixed income instruments, but also what is going to likely happen to the dollar, the price of oil, and even international equities. These are all intertwined.
And that's the reason why we bring it up, because the fact that if interest rates, there's this imbalance, people from foreign countries might come over here and vice versa, and therefore there's this imbalance in the U.S. dollar. Most commodities, something like 90% of commodities, are priced in U.S. dollars.
Yep.
And so if there's this imbalance, you can see pressure, for example, on the price of oil.
That's right. So if the Federal Reserve does start cutting rates, it is likely that the U.S. dollar will start to depreciate, so go down in value relative to these foreign currencies. That oftentimes historically has been actually pretty good for international equities, so that's kind of a bonus there. In terms of the commodities, because most commodities are priced in dollars, what we might see are those commodity prices start to go up. There's what's called an inverse relationship between the value of the dollar and the price of something like oil. If oil is priced in U.S. dollars, the dollar goes down in value. For foreign purchasers of oil, they can afford more, and that tends to push the dollar price up. And so if we do see some dollar weakness, don't be shocked if we do see some of those commodity prices start to go up.
Why I want to bring it up as well is because policy makes a difference. And so there is a number of economists who are saying perhaps if Trump follows through and wins this thing, that the policies will be different than they are today. Some are suggesting perhaps more inflationary. Some are suggesting weaker dollar.
That's right. I've also heard some people taking the other side of that argument. And so it's like this classic economist thing. On the one hand, you have this. On the other hand, you have that, right? And so that's
that's the reason why, Brian, they talk about if you had 100 economists, you get 100 different opinions.
That's right. You might actually get 200 different opinions,
exactly.
Right? Because they might have multiple conflicting views. This is really important when we think about how to invest through this, about the importance of being aware, working with a professional, trying to be nimble, not necessarily trying to make dramatic changes, because let's face it, the companies that you can invest in, they are adaptable. They're managed by professionals, and they've seen all sorts of different environments. We've seen high taxes, low taxes. We've seen trade barriers, not trade barriers. And yet the equity markets over the longer arc of history has actually still done well, because what matters is their ability to adapt to that changing environment.